Hello there, this is forexbrokers.net, and today we talk about the value of money or inflation, or what drives the value of money. And that's especially important on the currency market because inflation is a major driver of interest rates, high or lower. All central banks have a mandate that revolves around inflation, and changes in interest rate level due to inflation affect the market quotation, the market price. This is the euro and the US dollar. The euro and the US dollar that trades 1837 on September the 10th, 2020 on the ECB decision. The ECB did not announce the interest rate yet, and the press conference is still in front of us. But it is a very suitable time to discuss inflation and the value of money, because the ECB is under tremendous pressure lately. Why? Because inflation dropped significantly. Now let me share here two things. Number one is, let's say this is the zero level. So this is the zero level. What does it mean, zero level? When inflation reaches zero, the zero inflationary level. And then every central bank in the world, but absolutely every central bank in the world, at least in the developed world, has an inflation target that goes around 2%. Now why is that? 2%. 2% is the equivalent of price stability in central banking world. Price stability means that inflation at 2% is far away from the zero level, so not to threaten deflation. When inflation drops below the zero level, this is called deflation. Let's actually write it here. This is called deflation. And it represents one of the most difficult economic phenomena a central bank faces, and there is literally no known solution for it. If you don't believe me, just check at what Bank of Japan struggled with for the last 2 or even 3 decades, and even now it fails to bring inflation to the target. So when inflation moves below zero, it causes deflation. In plain English, what does it mean, deflation? Deflation means triggers a vicious circle. It means that the consumers postpone purchases. For instance, assume that you want to buy a smartphone, and you want to buy a smartphone. You have the money available, and you go to the store to buy it. And you see that actually you were willing to pay for it $500, and the cost is $450. You may say, well, okay, I might wait a couple of months to see what would be the price on Black Friday, for instance. And then on Black Friday you will see it is $380, and you will say, well, I wait until Christmas, and then on Christmas it's $350, and so you postpone the decision. The money is not moving, the velocity of money in the economy declines, and that means that inventories are rising at the wholesalers. Factories are not producing anymore or at the same level, and so on and so forth. People will lose their jobs, unemployment benefits will be on the rise, the government will have more expenses, the account deficit will increase. As you can see, it triggers a vicious circle, this deflationary level. And therefore, the consensus among central banks is that a 2% level is far away from the zero level, but not too far for other negative inflation perspectives like hyperinflation. What does it mean, hyperinflation? If you have inflation at 20%, 15%, and so on, and even more, let's say 20%, right? That's called hyperinflation. Hyperinflation usually forms in emerging markets, frontier markets. Think of Turkey, Venezuela, Russia, Eastern Europe after the communism, and so on and so forth, where people do not trust the central bank, or the central bank lost its credibility in keeping the value of money. And when the value of money is lost, people turn to alternative investments to protect their savings, like gold, for instance, jewelries, physical gold, or physical assets, houses, cars, something that keeps the value when the money loses the value, when the fiat money loses value. Another important concept in terms of the value of money is a drop in inflation. Let's assume that inflation drops from 22, put it here, 22, 5%. This is called a drop in inflation. This is called disinflation. So when inflation still drops but remains in positive territory, that's called disinflation. To some extent, disinflation is a good thing, in the sense that when it comes from higher levels towards the central bank's target, it's a good thing. But when disinflation happens between 2 and 0, then that's a problem, and it's not a good thing anymore, because the central bank will not favor this thing and will intervene. So is the case with the ECB today, in the sense that the ECB, or the core inflation in the euro area, is at record low, 0.4%. Now 0.4% is something that is far away from the ECB target of 2%. The ECB's mandate, or price stability mandate, calls for keeping inflation, or bringing inflation below but close to 2%. 0.4 is far away from the 2% level. And the recent euro strength, this is the euro US dollar, jumping from 0.8 to 1.20 in less than 3 or 4 months, put further pressure on the inflation to drop even more, and threatens to break into the below the 0 level. Therefore, the ECB, or any central bank, as a matter of fact, will be forced to intervene. How does a central bank intervene? It cuts the interest rates, it delivers quantitative easing, it uses other unconventional monetary policies like TLTROs, which are targeting long-term refinancing operations in order to provide stimulus and to stimulate businesses to borrow and to expand their activity, and so on and so forth. So the value of money is very important for the society as a whole, and the central bank is there to make sure that the money is not losing its value, and 2% represents the price stability and the target for a central bank. The problem is that in this game of inflation, central bank, fiat money, population, there's all about trust. If trust or credibility disappears, then you will have a problem in bringing inflation to target, and in people believing that you are able to fulfill your mandate. And that's the danger on the ECB, for instance. If the ECB, or if the people fail to believe that the ECB is able to bring inflation to the target, inflation actually will keep dropping below the 0 level, which will further put pressure on economic downturn and economic recession, unemployment, and so on and so forth. Thank you for being here, and have a great day.